Hi, my name's Adam. Welcome to the channel. Today we're going to talk about how much you need to retire in Canada. And obviously this is not a cookie cutter answer because everyone's situation is different. Now, we live in a country where, it's very expensive to live in the most part. Things to buy are expensive and we live a pretty good life in general. So, we probably need more in Canada than many other countries. But diving into Canada and retiring in Canada, how much money do you actually need? So we're going to run through a few examples in this video. I'm going to go through some things that a lot of our clients don't think about going into their financial plan and what a financial plan should look like and kind of the data and numbers it should drive out to you. And if you don't have this type of data, then you want to make sure that you're working with someone that can provide this data for you. So let's jump into it. So the amount of money that you're going to need in retirement is really going to be affected by, when you retire. Like, what age are you when you retire? Your lifestyle when you retire. How much pension money you have, how much your old age security and OAS is going to be. So, if we look at how much bucket of money do we need over here to fund our lifestyle over here, how many other kind of income streams do we have coming in to the income stream bucket already? So if you already have a pension, you're collecting CPP and OAS, and maybe you got rental property and everything like that, then maybe your bucket's going to be, the need for your bucket's going to be a little smaller because you have more income streams already. Maybe you have a very extravagant lifestyle and you're going to need a much larger bucket. So everybody's situation is very different. Now, one of the common, rules out there is the 4% rule, which says that if you pull out 4% of your money every single year out of your bucket, then your bucket should last for your entire life. So let's use an example. Let's say you need total income of $50,000 every single year. And between your CPP and OAS, which are your only other income, you're bringing in about $10,000. So simple math, 50,000 minus the 10 you're already collecting, you're left with an income need of $40,000. So, if we took a bucket, if your bucket was full with $1 million and we took out 4% every year, which equals to $40,000, then technically, a lot of theory says that will last forever. And that means that you need $1 million. So do I agree with that? Not really. There's inflation that comes into account. Everyone's income or lifestyle needs is a bit different. It's not a perfect formula. And there's a lot of videos on there, preaching the 4% rule or against it. I'm more of against it than for it. And I don't think it's a pure principle that you should plan your retirement, lifestyle or income stream off of. From our experience with clients and Canadians right across Canada is on average, when you retire, you're going to need about 60 to 70% of your current net income. So the amount of money you have after taxes in your pocket, about 60 to 70% over retirement. Now, there's 3 phases of retirement that we look at. There's the go-go phase, which is early on in retirement. You're doing more travel, you're healthy, you're spending more money, you're doing more things. Then there's the middle phase, which is the slow go. Travel becomes less, you're spending less, you're getting out more, you're doing less, you're spending less. And then there's the no-go phase, which is you're not traveling, your cost of living is much lower. Now, a lot of people argue that the no-go phase is when your medical bills increase exponentially, which in theory is true. We don't usually actually see that across the board with our clients, but most common, if we break it down, you're going to spend a lot more in the first phase, less in the second, and much less in the third phase as a whole between all your expenses, whether it's looking at travel or health style. So that's kind of the breakdown of the 3 phases of retirement. So when we say that on average you need 60 to 70%, you might need 90 to 100% in your go-go phase, but only 30% in your no-go phase. So we look at it as what's the average over the 3 different phases of retirement. So before I jump into a couple examples and break down the numbers, I want to go through some facts that I found online, which I find so interesting. And, the big banks and financial institutions do polls every year or two. And this one was done by CIBC. 32% of Canadians between 45 and 64, so pre-retirees, which is a lot of you watching these videos, have nothing saved for retirement, which is absolutely scary. And everyone that falls into that bucket really falls in for different reasons, whether you were neglecting savings, you had a bad experience in life, whatever it is. But if you're sitting in that situation where you have nothing saved for retirement and you're within 10, 15, 20 years of retirement, it's not too late. Everything you save now will make a big impact in retirement. So, put your head down, grind away, create a plan, a tax efficient plan, one that will, give you some tax breaks now, maybe through using your RSPs. Whatever your situation is, just start plugging away and building up a bit of a retirement plan so that you have something when you hit retirement. The second fact that I found very interesting was 53% don't know if they've saved enough, which means that you don't have a plan, right? If you don't know if you've saved enough, that means you don't have a plan. If you have a plan, you know that you've saved enough. And there's actually a crazy stat. So 75% of people are confident that they understand how much they'll need for expenses, but 73% are stressed about potentially outliving their savings. Again, if you're sitting watching this, and I know some of my clients are watching this, and we've gone through the numbers and they're still stressed about it, give me a call. Let's break down your numbers again. Because if you're stressed about running out of money, then your plan isn't properly structured, or at least you haven't understood your plan to this point. So, if you don't have a plan, get a plan in place. Understand exactly how much you can draw out, how long it'll last, and if things happen in the market, how does that affect your retirement income stream, and does it affect it? So I want to look at some specific examples of how much you would need in retirement. So let's take a single 65-year-old. They're collecting CPP and OAS. So CPP is $1,000 a month, OAS is $600 a month, and they need $4,000 before taxes. So we won't consider taxes in this example. So total monthly income they're going to need out of their account, out of their retirement savings, is $2,400. Now, why I'm not putting taxes into this, because we don't know where that income's coming from. Maybe they've built up a really large TFSA and all their income is tax-free. Maybe it's RSP, maybe it's other. So we don't know where it's coming from. So let's assume they need $4,000 gross income. They already have $1,600. We need $2,400 extra dollars of income every single month to pay their bills. So if we looked at a 3% rate of return, so we're basing it off, again, a 65-year-old living till 90. So life expectancy is 90 years old. At 3%, they're going to require $506,103. So, if you're 65 and you need an extra $2,400 per month of income, and you say, well, I'm going to get a 3% rate of return on average net, then you need just over $500,000 to provide that income all the way to age 90. And what that means is you'd have that bucket of $506,000, and over time your bucket would get smaller and smaller. Okay, so the whole idea is to draw down not just dividends and interest that they're paid out, but draw down on the capital as well. So at 90 there would be zero left. So that's what we're basing that number off of. If you could get 5%, you'd only need $410,000. Okay, so getting a few extra percent in retirement on your savings makes a big difference. But again, usually getting a bit of a higher return means taking a bit more risk. So I'm not saying 3%, 5%, it could be 5 to 7, whatever the difference is. The higher the rate of return, likely the higher risk you need to take. So make sure that you look at your risk tolerance, and then make sure that your bucket of money is going to fit within your risk tolerance to provide the income that you need. So let's look at a second example, and this is a 65-year-old couple, both collecting CPP and OAS. So combined CPP is $1,500 a month, and OAS is $1,200 a month. They also have a small pension plan that's paying them $1,000 a month. This is a very common scenario. So the last scenario, the single 65-year-old, that income stream, again, that's a very common scenario we see walk into our office. And this is a second very common scenario. So I wanted to use two examples that we see, almost weekly walk in our office. So again, 65-year-old couple, life expectancy to 90, both collecting CPP and OAS, and have $1,000 of pension income, just a small pension from a job they had back in the day. So their income need is $5,000 per month. Again, not looking at taxes on this. So they have $1,500 CPP, $1,200 OAS, and $1,000 pension. Their required investment redemption or other income is $1,300 a month. So if we can average a 3% rate of return, they're gonna get $274,000 bucket they need to generate that income all the way, for the next 25 years to age 90. If they get 5%, it's $222,000. $378. So, again, a bit less money in the bucket needed to drive that income. So again, this exact example isn't off, how much rate of return you can get. I'm just saying, when you look at how much money you need in retirement, consider your risk tolerance, how much risk you're willing to take in your portfolio, because that's going to affect your overall return, which obviously affects how much money you need to start generating that ongoing income. So looking at that example, a couple that, collect CPP, OAS, and have like a small pension, maybe it's rental income, whatever it is, a small amount of income from elsewhere of $1,000 a month, for $5,000 monthly income, which again, is probably more than enough for most retirees that we see on average. So, to drive that income, you only need about $1,300 more per month. You need about $250,000 of investment. So this whole fallacy, a lot of people say, well, Adam, how much do I need in my bucket to be able to retire? Do I need $1 million? Well, probably not. $1 million is going to give you a better lifestyle. If you don't have as much CPP or maybe that pension income, yeah, you'll need a bit more money over here. But if you have your CPP, your OAS, and maybe a little bit of other income, you really don't need that huge bucket that a lot of people think they need. So again, break down your numbers with your financial planner, see how much you need put aside for retirement to meet your income stream needs. And that'll just give you a better idea. But again, I think a lot of people think we need $1 million, $2 million. And the reality is you probably don't, because people don't think about other income streams, but also the fact that you're drawing down on your principal. Most people think that, $1 million at 5%, that's $50,000 a year of income. But then you're not touching the principal, which is fine. If that's your plan, that's fine. We have clients that are doing that. They want to leave the principal to kids and grandkids. That's perfect. That's a great plan. But if you're stressed about this and you're not saving enough, maybe, remember that you probably are going to draw down on principal, which gives you a bit more income than your just 5% or 4% dividend payout that you're getting. The very last thing I want to go through here is a actual financial plan that we put together for our clients. And if you're interested in the financial plan, I'll just cut back to myself here. If you're interested in a financial plan, reach out to our office. We provide, financial plans for individuals, couples, businesses, whatever it is that your situation is. We can put a financial plan together for you, and many of you have reached out to us. So info@parallelwealth.com. We can book a call, jump on a call or a Zoom, and go through what that looks like. So right now, about 5 of you are reaching out every single week, and I appreciate it. And we've, a lot of you have actually started working with our office, whether it's on a fee for service, which means that we build out a financial plan specific to your situations and needs and goals and objectives. And work with you over the next year or potentially longer to make sure that that plan is implemented, it's solid, it makes sense, but that you understand it as well. On the flip side, if you are looking for a financial plan and you have assets that are maybe managed at the bank or other financial institution and you're not happy with that, we also have partnerships with investment counsel firms. And we kind of quarterback the whole thing. So a lot of our clients have their assets managed elsewhere. We use a firm out of Winnipeg primarily, and they have a blue chip dividend paying stock portfolio that they manage for our clients. We come in and do the financial planning. We charge one overall fee for that, and it's much lower than you're probably paying at your bank or financial institution. So you get our office doing professional financial planning, putting plans together for you, which I'll show you in a sec. And then you get a big team. And all they do is manage money. So you're getting kind of two professional offices for one much lower fee than what you're probably paying now. And so that's the second option. So there's a fee-based and a fee-for-service. So we have both options. Reach out to us. We'd love to kind of walk through that with you, see what the best option is for you. And if we can help you out, we'd love to kind of jump into that and start working with you. So again, info@parallelwealth.com. But let's jump into an example. So this is some software that we use for our clients. And I'm just going to highlight age 65, okay? So in 2025, they're 65 years old. And you can see here in real dollars, okay? So this is what they're actually collecting in today's dollars, okay? Adjusted for inflation, $69,313. Then you have nominal dollars. So what the difference is, real dollars is, in today's dollars. Nominal dollars is the actual amount they're going to have in their pocket after inflation adjustments, okay? So if we fast forward to the last column here when they're 74 years old, you can see that same number, $69,313. That's in today's buying power. If we want to look forward in nominal dollars is 89,000. So that means that in 2034, when they're 74 years old, they will actually be collecting in their pocket after tax 89,663. But that's equivalent to 69,313 in today's dollars. So it's adjusted for inflation, because we know that something in 2034 is going to be worth much more than it is today. So we want to keep kind of that lifestyle the same. So if $69,000 is needed today, what is that actually worth in 2034? Well, it's worth 89,663. Looking at that bottom column as well, you can see kind of where income comes from, so CPP and OAS. Now, look on the far right, taxable income and total tax payable. So you can see, the average tax rate is probably about 6%. So we will break down the exact amount of tax. And as I fast forward, we can see here. So, in 2039, so this is age 79 for John, the husband, again, income, where the income's coming from, how much we're drawing out of each account, if there's any debt repayment, which they were working on earlier on, taxable income, total tax John will pay, marginal tax rate. So if he takes out more money out of a taxable account, on average, he'll pay 20% on every dollar that he pulls out. And his effective tax rate is 7.65%. So if you took the total tax payable, $39.49, divided by his total income, it would work out to an effective or average tax rate of 7.65%. So that's the detail that your financial plan should have. It should show you, how much income you're gonna produce, where it's going to come from, how long it'll last, how much tax you're gonna pay, how, a percentage of tax. If you take more money out of your registered accounts, what's the percentage of tax you're gonna pay on every dollar beyond that current redemption? And lastly, you wanna know what your estate plan is. So in this structure, we can actually go through and show you what your estate's going to look like in retirement. So we can go through, there's a bunch of data on here. I'm scrolling through it pretty fast here, but we'll go through recommendations. You can see exactly, if you passed away at 85, how much is left after tax to your estate, to a charity, to your kids, to your grandkids, whoever you're leaving money to. We will give you that exact number. So we're able to create these plans for our clients that tell them, how much you need, where it's going to come from, how much tax you're going to pay, and how long it'll last. I think, when we look at tax planning, how much money you need to retire in Canada, you need a proper plan. You need to make sure that it all comes together. And so make sure that you work with a financial planner. If you can't find one in your area, reach out to us. We work with people right across Canada. But we want to make sure that as a Canadian, you enter retirement understanding, how much you need, which takes pre-planning before retirement, but also when you enter retirement, that transition, I talked with someone yesterday, that transition from collecting a paycheck to creating your own paychecks, it's very complicated. And a lot of people, stress about it, worry about it, and they don't know kind of where to start. Meet with a financial planner, put a plan together. It's going to cost you between $2,500 and $5,000 for a good in-depth financial plan. We are on the lower end of that. And the reason is because we want to make sure that it's accessible to all Canadians. So, we've seen plans as low as $1,000. They're not going to be as in-depth. They're not going to give you the detail you need. We've seen them up to $10,000. And that's probably more complex cases, corporations, that kind of stuff. So we're not here to push our services. That's not why we've started this YouTube channel. We want to just provide you with good information. Find a financial planner in your area. Again, just work with somebody, build out a plan. It's going to cost you a bit of money, or if you're paying a fee to your financial planner already through your investments, they should be providing this. If they're not, then you might want to think about switching to a different financial planner. But again, all we want is for Canadians to retire in better situations. And we know that creating a financial plan brings so much value. Vanguard did a study last year around that, how much value a financial planner brings. And a lot of people are, hesitant to spend a bit of money to get a financial plan. But I can tell you firsthand, those that we put plans together, they're always, at the end of it, they're always so happy that they did it. They have a better understanding, much less stress in retirement. They know where their income's coming from. And we've probably been able to save you, taxes and just create structure where our fees offset themselves very quickly. So whether it's myself or another financial planner in your area, just reach out. We'll put a link below to find a CFPS certified financial planner in your area so that you can start working with someone to build out a retirement plan and just bring comfort and less stress to your retirement. Retirement should be fun, enjoyable time. So don't let money, stress, and trouble ruin that. So thanks so much for joining us today. If you enjoy these videos, if it's content that adds value to you, hit the thumbs up. It really does help get these videos out to more people. And again, if you haven't subscribed to the channel, hit the subscribe button. It's free. It takes 1 second. We release 2 to 3 videos every single week on financial, retirement, estate, and tax planning. So thanks for joining us today. We'll see you in the next video.